So I'll introduce my panel here. We have Patrick here, who has spent, I think, when I looked at your LinkedIn, 20 years basically in fraud. So that's you should have some deep experience in how that's evolved. John's new in the role, leading Scotia, which is one of our largest auto lenders in Canada. Full spectrum from subvented all the way through to non-prime. So he's a chance to see kind of the full meal deal of what we're getting and what's happened over the last few years. And then Chris leads product at Equifax on fraud solutions and a whole bunch of research and reports coming out of you guys. So. And I work at a company called Credit App, and you can look it up. It's not for me here. In any case, so I think we'll start with John, but we're at an interesting inflection point for our industry. We've historically used credit files as our check and been pretty good at checking credit for validity of our customer. We're trying to introduce better checking of the identity of the individual. We've leaned in an industry with IDV as one of the tools. And what are you seeing today, and what's Scotiabank looking to do as you kind of lean into this new Wild West that we've created?
Yeah, thanks, Marcos. First, I'd like to thank the CLA of giving us our preferred time slot of second after lunch, just making sure foods hit everybody. But I'd like to actually kick off by so great to see so many industry leaders here and former colleagues actually up on this stage. So it's really nice to see that. Obviously, Scotia has been in auto finance for 65 years. We just launched recently a requirement for IDV to be sent in with our funding packages for a certain segment of our dealers. Kind of under no illusions that this is going to solve all of our problems. It just and thank you to the my industry colleagues for letting us go first on that. By the way, that was nice. And it's going as you thought it might go. We've got 1,000 deals we're holding up in funding. We've got stamps that say pass on white pieces of paper that our dealers have sent in to us.
We got a call on, I think, Friday from dealers like, we need IDV now. And so they got turned on in about 10 minutes, and they wanted to fund their Scotia deal.
Yeah, no one read the memo. It's exactly how you thought it might go. And some dealers are doing okay. It's not everybody, but we knew it would be challenging. I was up here last year, and we talked a little bit about IDV as well at that time. And for me, it was important that we really start to move the industry forward, and that's why we wanted to go on this. I don't think it's going to be a perfect solution for us. It's going to help, of course. I don't know if everyone has read. There was an article last month in the CBC. 1.4 million Canadians in 2026 will have their or either on temporary work permits or temporary visas, and with new, more stringent requirements from the government, those will be expiring, and we don't know how many of those are going to be renewed. That's concerning for us. There was 1 million that happened to last year, 1.4 million this year. I don't think some of those people we learned from last year are selling their identities. Some have credit profiles. This won't protect us necessarily from that. It might help a little bit. I think the bust out problem is going to continue. We're very concerned about it. And I'm probably talking a lot longer than you thought I was going to go here, but I'm going to run with this while I've got the time. But I think as an industry, we need to step up our game. We need to start working together. I was actually glad to hear the cars are up here talking about sharing data, because we need to do a better job of sharing data at the time of application, or this bust out problem, which is, I think, a much bigger problem for us right now, is not going to be resolved. And the challenge from our industry suppliers and vendors, who are all trying to come up with solutions, is, they only cover a part of the segment. And so portals only cover what they cover. They don't share data. Maybe no offense to my bureau colleagues up here, you guys aren't known to cross-pollinate all your data very much. And so for us, it becomes a challenge because we keep missing parts of the segment. So people keep coming to us with solutions that doesn't really capture everything. And I was in the U.S. last week, and sat and watched a fraud panel, and there was a number of very large lenders up there. They put a task force together where the lenders have put a task force together. They're working together collaboratively to figure out how they tackle this problem. And I feel like if we're really going to solve it, it's going to be a lender-driven solution as opposed to just a supplier or vendor or partner-driven solution. I don't think we can get there otherwise. So my ask would be of my colleagues out here is that we put some people on this and we figure out how do we work together, whether it's a clean data room, whether it's at the time it hits our LOS, but there's just too many. There's too many portals. There's too many ways that people can hit different bureaus to be able to stop a bust out on the first or second time, and so that's what I'm worried about. But that so far what we're doing, we put IDV and we've launched it. It's been rocky, but we're committed to solving it.
And I think we're going to talk about IDV and some of the weaknesses. It's better than nothing, and we see it catching stuff today that yesterday was going to get funded and was going to be a loss.
Yeah, look, we've had certain levels of IDV in place for some of our OEMs where we act as a captive for. The one of them has about a 4% fail rate, and so that doesn't necessarily mean it's 4% of the customers. Perhaps they're trying multiple times, but is it 1% or 2%? As an FI, I can't absorb a 1 or 2% loss rate just on fraud. I mean, it's crazy.
Yeah. So maybe now go to Chris. When we had our call, you had a nice quip, and I'll let you fill it in. But we need to evolve from creditworthiness to customers I can trust.
Yeah, happy to fill that in. So where that comment came from is I think over time we've conflated the notion of creditworthiness with trust. And it makes sense. In years gone by, someone who is likely to repay their bills, likely to be a real individual. But what we know now about how synthetics operate and how fraudsters operate is there's no longer, if there was any link, there is no longer any link. So increasingly we're seeing our clients and the industry shift from just looking at one single data point to looking at different solutions, different data. Now, the challenge there, and I think it might have been Michael earlier talking about how do we reduce the friction or not introduce friction that's going to lose deals that are perfectly valid deals, but still weed out the fraudsters or the illegitimate profiles. I think where we need to go there is something that's closer to dynamic friction. So it's not a one-size-fits-all. I'm not going to put everyone through the same process like I may have done 5 years ago. I'm going to say, you've accumulated enough in terms of risk signals, in terms of trust signals rather than risk signals, that I can say, you get fast-tracked, you are expedited. And that doesn't have to be specific data points from a technology provider. That can be things like existing relationships that you've had with a customer for many years. There's a certain threshold that you need to reach in order to say, I now trust this individual. Now, the way that we're seeing that more and more, particularly in a digital space, is how do I build in alternative data that's not necessarily financial data? So a synthetic ID or a ghost customer, as we've been calling them today, it's really a profile that only exists in a financial sense because that's the end goal, is to bust out on that profile. But it's a lot rarer for one of those bad actors to go and create a non-financial history or a non-financial profile around that identity. So you may think, I'm financing an auto deal. Why would I care whether the email address was created 2 days ago? The reality is a perfect credit profile paired with risk signals like a brand new email, like a e-commerce history that doesn't exist for that person. I look around the room now, everyone here, unless you've taken great pains to avoid it, has an extensive e-commerce history, and COVID pretty much made sure of that. So to not see that associated with an identity, that's an immediate red flag. So we're seeing more and more of our clients saying, what can you give me in the way of alternative data that I can mix into that decisioning process to give me a higher level of trust?
Yeah, we like to think in our business, we call it building confidence. And so John comes in and everything looks kind of good. My confidence in my counterparty is high. You come in and, boy, I don't like the Aussies that much. He's only been here for a couple years. My confidence is lower. I should do a couple extra things. And so I think that shift, I think, is important. And how do we make that easy for lenders, for sure?
And just on that, Marcus, it's one of those things, as a person who migrated to Canada a number of years ago, to the first credit provider, to the first telco that I approached, I look no different to a synthetic identity. It's very hard to distinguish those two outside of the regular KYC processes that we all have. So that is what makes synthetic ID a particular problem, because new to credit, new to Canada looks very similar to a synthetic fraudster.
Totally agree. Patrick, just give you your lead in. We have our little pre-call, and Patrick's, and I wrote it down on top of my paper. It's going to get worse. Go ahead with the reports and what you've seen and your very rosy prediction.
Yeah, it's definitely not positive. So just kind of building off what we've already talked about, to be fully honest. So we've done a couple of studies over the past 12 months. So last year we submitted 2, and we've done some deep analysis. So I think the most important thing is understanding how the fraud has happened, not how did they pass this one control or 2 controls. Those can be simply patched, yes, but they'll find another way through. They're just like water running down, they'll go to the path of least resistance. So by John implementing this doc auth, it's just gonna push the fraud to someone else. It's not going away. It's just, this is a shell game, right? Push it to your competitor, move it around. But the reason why I think it's getting worse, once we really got into the study and took a look at it, we took a look at, number one, delinquencies were going absolutely through the roof. Everybody in market, if I'm going back to 2023, I'm gonna go to Q3 of 2023, everyone was saying first-party fraud is on the rise. We are getting crushed. We don't have a solution for first-party. My team and I took this back, and we kind of thought to ourselves, could this many Canadians be waking up in the morning and saying, I'm going to steal a car today. I'm going to rob this credit card company, and I'm not going to pay it back. I refuse to believe that the large percentage that we saw of Canadians would do this. The second thing was, everyone said it's either that or it's new to country. The new to country, new to credit are killing us. So those were our 2 studies last year. We looked at delinquencies, and then off that delinquency study, we then looked at what we called departure defaults. So people leaving the country and busting out. The first study that we did is called the hidden culprit. The hidden culprit was not first-party fraud. I can say this very confidently today. If you think you have a first-party fraud problem, there's a bigger problem internally within your 4 walls, and I invite you to come to us and we can help out with that. What we're seeing now, and that study showed, is that synthetic identities, if I go back 21 years, I'm almost at 21 years in fraud. If we saw something that was open in 6 to 12 months ago, we knew right away, this is synthetic. Recently, we've seen upwards of 11 to 12 years of credit nurturing, which is what we're calling the long-haul synthetic. So today, they created it 12 years ago, it looks like a first-party fraud. So I understand why the industry was saying there's a first-party fraud issue. There's just no tools out there to help us with this. The government would be the source of truth, but we all know getting information, validation, so on, could be difficult. So the first study we did, again, was the hidden culprit. We found 30% of delinquencies looking at a 12-month window that went delinquent 90 plus days in 9 months on book was attributed to fraud, so 30%. And when you look at the risk threshold, so prime wasn't too bad. It was around 20% of it was fraud. But when you think about super prime and prime, they typically don't go bad. They go bad at a very low rate. So once we saw those high rates, that's where we kind of saw it. So we equated in that 12-month window, $162 million of delinquencies in the Canadian market were 100% fraud. I'm very confident in that. The way we ascertain that is we've developed, and this is where we need to kind of move to and get away from the point solutions, and you've heard a strong fraud solution is a layered solution. I don't disagree, but that's not going to get you to where you need to have a strong fraud strategy. You need data and analytics. You need to run it 100% analytics with a few point solutions off to the side. So we've developed models, so significantly advanced XGBoost models, ML learning methodology, and we've actually developed first-party models, third-party models, and synthetic models that actually detect it with high accuracy. And that first-party model, although it's called first-party, I'm going to call it no intent to pay. So whether you're a good or you're a bad identity, we know you're not going to pay, and we're actually able to predict that, and that's how we've kind of driven the study. Once we showed this study to the market, 162 million is just the auto loans. Overall, it was 409 million when you look at all the financial products and include telco in that number. Massive, that we can say is fraud. So we're all paying for this. I can't remember who said it this morning, but it's always going to come back to us. Even when I was talking to my insurance company, I got a new car in May. The agent actually said to me, well, the rates are high because there's a lot of fraud. And I said, I don't care. I'm not paying for your inability to detect fraud and prevent and stop it. So the second study, and sorry, I'll wrap it up, I know I'm going long, was to look at those departure defaults, because a lot of the major financial institutions came to us and said, we understand your study, we're not challenging your numbers, but we're challenging that we don't think it's synthetic. We think it's people leaving the country or departing or busting out. So we called it departure defaults. We thought reverse immigration was kind of a negative connotation, so we're calling it departure default. A very, very small percentage of people are leaving. They are selling their IDs. I mean, you can go online into the dark web and you'll see people selling these, trading them, reaching out. You even have cab drivers actually asked our regional president for his information and would he sell it, not knowing that he was the regional president of TransUnion, because he is Colombian and they just thought maybe he would go home one day. Just to show you. So we know firsthand that it is happening. We know there's pockets of new to country that are very risky. I'll tell you, it's not the pockets that I would typically, and maybe you would typically think of. It's really the international students was probably the only risky bucket, but we already know they're leaving, potentially going back home. So yeah, a lot of those studies, if you're interested in them, there's a bunch of TransUnion people here, your rep, come to me. I'm happy to share that with you, and we can kind of go over it all.
Awesome. I want to forsake us in two directions here, but maybe I'll just quantify a little bit of a story. So I remember being in my dorm room in '95 to date myself, and there was a guy sitting there generating fake credit cards. The internet was pretty new at that point in time. There wasn't that much going on. You couldn't buy that much online, and he never did stay in university for very long, and I don't know what he's doing now. Fast forward to today, we're in probably the biggest capital cycle we've seen in technology. We have $650 billion by 5 companies deployed into capital. AI tools are stronger than ever. As part of this panel, we kind of joked we would do a Creating Gary, and I would show up here with Gary's ID with my face on it. 10 minutes, I figured out Gary's born in Zambia. Gary went to Cambridge, and I'm pretty sure I got Gary's birthday within 3 years. So I could get 3 IDs for $175. They'd look like Ontario IDs. They would pass every digital ID fraud or scanner, have my beautiful face on there. And if I got it right, Gary would own a couple cars I didn't plan on paying for. Then, if I wanted to sound like Gary when they called me, we could upload Gary's voice. I have Gary's cell phone. I could chat with him for 30 seconds. I can upload his voice, and I can sound like Gary at a dealer. And so it's only going to get more tricky. And so that leads me to, and this is for you, John. Indirect lending is a curious business. If I want to work at a Scotiabank branch, I have a whole bunch of requirements on the PC that I use and how I log in. And if I want to be a Scotiabank advisor, I have licensing requirements, et cetera. But yet we trust our indirect lending group to deploy capital for us and do things right. That would never meet even the most remote standard that we have as a bank. And so
there's no regulators in the room.
No.
Is there? No. It's not going anywhere before I answer this question.
And so, and that's how our industry's evolved. And that individual represents lots of us. And they might not have their own login to the systems that they access to us, et cetera. What role does the dealer play? And how do we as an industry try and help them? Everyone's an economic actor. They want to move metal, service metal, trade in metal. And we carry very long tail risk on what we buy. How do we as an industry try and help them? Because I don't think they're necessarily bad by nature.
It's a great question. And it's very challenging, and I'll just share a story. So one of our partners had been doing IDV for a number of dealers, and they were able to share that they had, in just early days, so early days, they had 3 instances where dealers failed their IDV requirements. In all three cases, they were able to confirm that those deals went back into the marketplace to a different lender that didn't require IDV. And they were reputable stores. I had them, they were good enough to share the stores with me. Reputable dealers, groups in some cases, but you're probably dealing with an employee, right, who hits a roadblock and is trying to get a vehicle over the curb, and they delivered them, and so it's very difficult, and so I would say we're not hinging our bets that we're going to get. Like, we deal with 4,000 dealers across the country, and so it might be easier for some of the captives, who have a different dealer network. For us, it's very challenging, and so we're really looking to an industry solution, and I think we do need to sort of elevate the industry, knowing how important that one, protecting data is, sharing, but like fundamentally for me, and it sounds easy to me because I have no technology experience whatsoever, but if Scott's approved a deal and I've got an approval out there, I just want to know that and be able to share with him. And it doesn't have to be between him and I, but that's what I want to be. And then if Rick gets an app, he might want to know that, hey, there's 2 approvals out here already, and then we can decide what we do with that information. And so, is it through our LOSs? Is it APIs? It's got to be something that's timely and quick, and we know that these deals are live and we can still react. I just to rely on getting the dealers. Now, obviously, look, we got dealer agreements that are designed to protect us, but fundamentally, I think as an industry, we've got to get together as lenders and solve it. So.
I agree. I think. What do you see? I mean, we see on our side, we see some dealer groups operating like enterprise accounts, full IDV, full background, like just really operating like you would expect and hope as a good partner. We see that with groups across the country, from the Maritimes to BC. But what do you see on your side with the bureaus? They all work with you guys as well. What's the mood change at the dealer now? FinTrack's got their arms around just the non-bank lenders, but dealers still operate reasonably in a unregulated environment.
I think the compliance element is the thing that's front of mind at the moment. That's what's going to drive things like IDV into market. The thing we have to be careful with when we're talking compliance solutions versus fraud solutions is compliance is about making sure the regulator's happy at the end of the day. The cost that I can do that for, if I can keep that as low as possible, then I've still met my objective as a dealer, as a lender. Now, where you need to think when it comes to fraud is I'm trying to prevent a loss for my business. So I think that is the key point. So yes, the regulations and the FinTrack purview being brought in for some of these parties is good. It's a good first step. It will start things like the IDV conversation, but I think we need to go beyond that. That's not going to address things like, and John makes a great point, like what are we doing cross-industry and also public to private to share when we have insights that would stop a deal going bad elsewhere? Because I think if we start playing this as we have for a long time as a zero-sum game, where I avoided the loss, that's great. That works for today, but you might be eating that loss tomorrow, right? So it's an ecosystem problem, which requires an ecosystem solution.
Yeah. Patrick?
Yeah, really well said. Actually, we see it the exact same way on the other side of the fence. The one thing I would add, and it's getting a lot more complex, they're not fraud solutions, to the earlier point, but what we need to do is kind of make that shift, right? Like, we are still doing things the same way as my dad did, and he's turning 80 this year, and he was a SVP of credit risk. He's still, I ask him all the time, like, how did you do this? And he explains it. I'm like, oh, crap, we're doing it the exact same way. So we need to make that shift and really accelerate our innovation and get to this stage where things are being shared. So, just to give you one scary story, and just feeds off the first question of why things are getting worse is it's ROI for these fraudsters. They are investing time. So I've already said 10, 11, 12 years building an identity. We saw one that just took 5 years to build. They got 2 credit cards in a telco trade. They paid all the time. They let their credit score go as high as humanly possible. In 29 days, 5 years later, they took 12 auto loans out, and they all got funded. 0 vehicles got found. Consumers were nowhere to be found. I'm going to be honest with you, me, anyone in this room, even new to country who's going back home, he or she, we don't have the resources to figure out what to do with 12 vehicles. This is organized crime. This is really where we need to get to. Predictive analytics, going back to the data and building this out, but also taking a look at historical, right? We've got so much data on our bureau side, and really what we've done and how we've unlocked it, keys to success, is that we've started looking, instead of one credit file and saying, oh, John, okay, that's your name, that's your address, oh, everything matches, it must be John. And we do verification and authentication. We think that's got to be John. Whether it's face-to-face or non-face-to-face, it doesn't change anything. But where we've really leaned into it is not looking at one file and looking at the entire sea of that bureau and saying, where else do we see John? Where else do we see this address? Where else do we see all the PI information? And there's things that really pop up that blow your mind. There's one case that we had that was 711, I'll say, but it might have been give or take 10 plus 10. Current address for 711 Canadian consumers. They don't live there. I'll tell you, we looked it up and it was an apartment. So it was even more unbelievable. But those are things you don't see pulling a single bureau looking at it, right? And that's where the predictive analytics comes in. And we've really looked at doing a 360 of the identity, but getting deep into the behavior, because we've also got trade line information. So I know John gets a new car every 4 years. He gets a new telco every 1 year. He gets credit card every 15 years. Or no, he's loyal to one bank. And he's never going to deviate from that. So when we see an application somewhere we wouldn't expect it, now that standard deviation is way off his normal behavior, and we're able to trigger risk off of it. So that's where we need to really mine our data that we have. The Bureau, like I said, we have a ton of data, but all of you, if we combine it together, which is what we've started doing, sky's the limit. I've never seen in the past 2 years the advancements go as quickly as I have in the first 19 years of my career in fraud.
Yeah, well said. Couple minutes here, so just wrap up with, we had fraud as a tax from Z before us. You heard it from you. You were upset. You didn't want to pay for that. And I think what's not well understood there is not only are you paying for that 1 or 2% extra default rate, the capital that's deploying against that. Well, now there's more volatility. So now I actually need a return of 4%, 400 basis points more for that 2% default. And now we got consumers that are tight, and we just increased their loan, and they're paying twice as much interest as they might have been. And so I think the tax is real. I think it's bad for Canadians. My big passion in being in this industry is I think we got to be able to save Canadians money on buying their cars. There's way too much friction in the system, and friction that doesn't take any profits away if we just do it right, and the benefit all goes back to our consumers and our people who live in this country. So John, last word. I'll get you just one last plea to the industry. We got to act a little more organized. There is an opportunity for us to, we in this room, I'm going to guess there's 95% of the capital that gets deployed to loan to automotives in Canada. If this room made a conscious choice to act a little bit more organized, I think we save Canadians money.
Yeah. Look, absolutely. I mean, I don't know how many more pleas I can make to the industry in one sitting. But I will say, and just going back to the earlier, the presenter right before us, when I hear auto thefts are down 30%, my assumption is they've just moved somewhere else. So it's gone from auto theft to they're finding it in financing. They're getting it from us, and so I don't have any illusions that that's going away and everyone's just given up stealing cars. They're just finding a different way to do it, and so. You really, and whether it's through, hey, CLA might be a great forum. I just think it's really worth it for us and my fellow colleagues out there to maybe looking at the people in this room. We might not be the right people to get together, but we certainly have the right people that can get together and help us work together to find a solution.
Thank you. Thanks, everyone.